Educational Guide. Understanding the world of stocks. Welcome to your ultimate beginner's guide to the stock market. This guide breaks down what stocks are, how they function, and the different ways you can invest in them. What exactly is a stock? Simply put, a stock represents ownership in a company. When you buy a stock, you literally own a tiny piece of that business. Shortcake, the chocolate cake analogy. Imagine your favorite company is a chocolate cake cut into thousands or millions of slices. Each slice is what we call a share. When you buy a share, you are buying a piece of that company. Example: if a popular streaming service were divided into exactly 10 shares total, and you owned 5 of them, you would own 50%, half of that entire company. In the real world, big companies have millions of shares, so an individual investor usually owns a very small percentage, but the concept of ownership remains exactly the same. 2. Why do companies sell shares? Companies sell stocks primarily to raise money. Creating and growing a business is incredibly expensive. They might need cash to build new factories, develop innovative new products, expand into different countries, pay off existing bills. Instead of borrowing money from a bank, which requires paying it back with high interest, companies sell shares. The money they receive from investors does not need to be paid back. It belongs to the company to keep and use for growth. 3. Case study: Maya's dream sneaker store. To understand how this works in the real world, let's look at the story of Maya and her store, Fresh Kicks. Total funding needed: $100,000. Maya's savings: $50,000. Keeps 5 shares / 50% ownership. Public investors: $50,000. Sells 5 shares / 50% ownership. Maya divides her business into 10 equal shares, valued at $10,000 each. An investor named Jordan buys 1 share for $10,000, giving him 10% ownership of the company. Scenario A. The success story: 5 years later. The business thrives and expands to 3 new locations. The company's total value jumps from $100,000 to $300,000. Jordan's 10% share: now worth $30,000. Net profit: if Jordan sells his share, he makes a clean $20,000 profit. Scenario B. The risk story, the downside. The store struggles to compete with massive online retailers, and its total business value drops down to $80,000. Jordan's 10% share: now only worth $8,000. Net loss: Jordan has lost $2,000 of his original investment. 4. Common stock versus preferred stock. When a company issues shares, they generally come in 2 distinct types. Think of them like regular tickets and VIP tickets to the same concert. Features: common stock, regular ticket; preferred stock, VIP ticket. Voting rights: ballot box, with ballot yes, 1 share equals 1 vote. Crossmark: no voting rights. Dividends warning: not guaranteed, paid only if the company has a great year. Money bag: guaranteed and fixed, paid out regularly. Growth potential: rocket highest potential, shares can skyrocket in value. Chart decreasing: limited growth, acts more like a steady income bond. Bankruptcy risk: stop sign: highest risk, last in line to get paid back. Shield: medium risk, paid back before common stockholders. V. Where do people buy stocks? People buy and sell these company shares at a stock exchange. This is a digital and physical marketplace for investors. Most famous exchanges: the New York Stock Exchange (NYSE) and the Nasdaq. Going public: when a private company grows large enough, it lists its shares on a public stock exchange so that anyone in the world can easily buy or sell pieces of the business. Modern access: today you do not need to physically visit an exchange. Anyone can purchase stocks instantly using investing apps on their smartphones. 6. Why invest in stocks instead of a bank? Keeping money safe in a bank account is secure, but it offers very low growth. Bank accounts typically yield only 1% to 2% in annual interest. The stock market historically returns an average of 7% to 10% per year over the long term. Warning: the golden rule of investing. Higher returns always come with higher risks. The stock market can be a volatile roller coaster. To protect yourself, never put all your eggs in one basket. Instead of buying just one stock, diversify your money across multiple different companies that you understand and believe in.